What if I told you that you don't need to predict the next big stock to build serious wealth? In 2026, investors are watching AI stocks, inflation, interest rates, and market volatility. But successful long-term investing doesn't have to be complicated. First, think long-term. Instead of constantly buying and selling based on market headlines, focus on staying invested for years or even decades. Markets will go up, markets will go down. The goal isn't to predict every crash or rally. The goal is to have a strategy you can actually stick with. Second, consider low-cost index funds. Instead of trying to find the next winning company, broad index funds can give you exposure to many companies at once. For long-term investors, diversification and keeping investment costs low can make a big difference. Third, automate your investing. Set up automatic contributions from every paycheck or every month. This approach, often called dollar cost averaging, means you keep investing regularly instead of waiting for the perfect moment. When prices are high, you buy fewer shares. When prices fall, you buy more. And most importantly, automation can help remove emotions from your investing decisions. Fourth, diversify. Don't put your entire financial future into one stock, one industry, or one trend. Depending on your goals and risk tolerance, diversification can include U.S. stocks, international investments, bonds, and other assets. And fifth, don't ignore retirement accounts. If you're eligible, consider using accounts such as a 401k or IRA. The earlier you start and the more consistently you contribute, the more time your money potentially has to compound. So remember this simple formula. Invest consistently, keep costs low, diversify, automate, and stay patient. Don't invest because something is trending on social media. Invest based on your goals, your risk tolerance, and your time horizon. Because when it comes to building wealth, patience may be one of your biggest advantages. This video is for educational purposes only and is not financial advice. Investing involves risk, including possible loss of your investment.